Hi guys, welcome back to my YouTube channel. So today I'm going to be talking about investing. I know it's been a while since I've been uploading, but I'm going to try to be more consistent over the coming few months. So let's see how that goes. So today I'm going to be talking about beginner investing. So not trading, not day trading, buying and selling stocks on a daily basis. I'm talking about investing, which is buying a stock or a fund and holding it for the long term. That's what I'm going to be talking about today. First things first is to have a backup fund. So before you even think about investing, you need to have at least 3 to 6 months of your expenses saved up in an easily accessible bank account. So that's the first things first before doing anything else. You need to have an emergency fund. And the reason for that is because you want to invest with confidence. You want to invest without thinking that you might need the money again, in a short space of time. So if you invest whilst you have a backup of savings in case you lose your job, in case your business goes under, in case your income levels change, or in case an emergency happens and you need a big payout or something like that, you definitely need an emergency fund between 3 to 6 months of your expenses saved up. That's the first things first. The second thing is never invest into something you don't know. Now, I got this actually from Warren Buffett. But anyway, so basically what that means is, right now you hear everything about Bitcoin, you hear about cryptocurrencies, you hear about all kinds of alternative investments, you hear about real estate, you hear about stocks, index funds, ETFs, gold, silver, everything else under the sun. There's just investments after last year's or 2020's big run. So guys, be careful. Only invest in what you know. If you are interested in other things, make sure you research it first before you touch it. And the reason for that is because you have more confidence if you invest in what you know than if you just follow other people blindly. So invest in what you know and you'll have more confidence in your investment and you'll be less likely to lose money in the long run. Not only that, you also have kind of like insider knowledge. So when things are undervalued, when things are overvalued, where the future is heading, where the market is right now within that specific niche. Another thing beginners should do is learn as much as possible about investing before you even take your hard-earned money and invest into something. So learn as much as you can about an investment. So that means reading books, opening a brokerage account, potentially putting some demo money in there. So just playing around with the fake money that's already in the platform, seeing how everything works from a day to day, seeing how fluctuations work, seeing all that in real time really helps. Of course, it's not the same as real money, but it does kind of give you some sort of experience. So reading books, podcasts, reading articles, following the right people on social media, keeping up with certain trends. So things like, Bloomberg and Financial Times are really good sources as well for general financial news and insight. So guys, make sure you do your research. So choosing a broker is really important. So you can't be going with, high fees or high management fees. And what that means is basically, some brokerage companies, they basically have high management fees where basically someone's managing your money and you're paying a percentage of that monthly, or it could be annually, just entirely depends. But on a long-term basis, that could end up being a lot of money eating into your returns. So all those returns which they could be theoretically making, that's all going to management fees. And funnily enough, the biggest income for investment bankers and money managers is actually from the fees rather than the investments that they make on behalf of their clients. So that's also an interesting insight for you guys to know. In terms of also starting, another thing to really think about is starting very simple. Now, it's obviously very tempting, especially in this day and age, in the information age where you hear everything left, right, and center on social media, in the news. You hear about cryptocurrencies and Bitcoin and everything else, and stocks and IPOs and SPACs and everything else under the sun. Guys, just start off simple. That is my advice. So, if I was beginning again, I would definitely go back to investing in index funds, start off there. Now, when it comes to investing, it's pretty much, in my opinion, just half is just psychology. So cutting out emotions. Now, this is a really, really difficult one, even for me as well. I mean, I'm definitely better at it now than I ever was before. If the market is going low or it's going, it's in the negatives, if you believe in what you're investing in, that's your opportunity to buy things at a discount. So even buy more when the market is down, and when it's high, keep buying, but of course maybe low down in terms of your average cost. So when you're dollar cost averaging, just keep it a bit lower than you usually would. Another thing to consider is deciding your risk profile. So like I mentioned, a really good place to start for beginners is the index funds. So they're lower risk, and they're really still great returns. And dollar cost averaging is going to be key here. So dollar cost averaging is just setting money aside every monthly. So for example, you could be buying Tesla every single month. Let's say $100 every month you buy Tesla. It doesn't matter if the market is going up, if the market is going down. So you're not entering too high, you're not entering too low. It's just the average, and you also get to realize the gains. So because it's better for you to have time in the market than to try and time the market. I mean, no one can even time the market. I mean, even Warren Buffett says, when he passes away, he's just going to put his money into an index fund and let the market just ride it out like that. So that tells you everything you need to know. Time in the market is more important than time in the market, because it's almost impossible to time the market. Another interesting stat as well is that if you miss the 3 best days of the year in the market, then you're making between just 1 to 2% versus, let's say, 9 to 10 to 11 plus. So if you just average cost, then you're obviously going to get those gains. Another thing which is amazing is dividends. Now, dividends is a share of the profit from the company that you invest in. Now, this can come from, of course, individual stocks. It can also come from index funds or ETFs as well. It just really depends. Most likely, you will be reinvesting those dividends. So, for example, if you invest, let's say, $100 or £100, then after whatever given time, let's say you end up with you make $10, so you end up with $110. The next time you invest again, you're not investing with $100 that you started with, you're investing with $110. So you keep reinvesting, and it keeps compounding. And lastly but not least, this is probably the most important in my opinion, which is compounding. Now, again, compounding just kind of summarizes everything I've been speaking about, especially with the dividend and also the dollar cost averaging. So compounding is literally just your money multiplying over a long term period. So for example, if you're receiving dividends and you're also dollar cost averaging, everything is getting reinvested, and also which means that the returns are larger every single time. And you also, of course, you set yourself up for the long term. So compounding is extremely important. So that's why you should avoid, withdrawing any money from your brokerage or anything else like that. If you're a beginner, I hope you found this video useful. But yeah, let me know if you have any questions below. Guys, just be careful out there. Take care. Thanks.